The silent whale, how a trillion-dollar entity is quietly buying all. The world's silver opening hook, there's a saying in the intelligence community that most people never hear. The loudest threats are rarely the most dangerous. It's the quiet ones, the silent hunters moving in darkness. Those are the ones you need to fear. Right now, while everyone is screaming about stocks, crypto, and the next meme coin, something unprecedented is happening in the silver market. Something so massive that when people finally understand what's occurring, it will already be too late to position themselves. And the strangest part, almost nobody is talking about it. Picture this, you're staring at the silver chart. Price hovering in the low 60s, it churns, it dips a few cents, bounces back, rises a few cents, then stops. Day after day, same boring range. To 99% of traders, this looks like nothing. The rally has stalled, the market is confused. Time to move on to something more exciting. But if you know what to look for, if you'll back the surface price and examine the volume beneath, you see something that should send chills down your spine. You see a war zone. Over the last several trading sessions, billions of dollars of paper silver have been dumped on this market. Banks have shorted aggressively. Algorithms have unleashed coordinated sell programs. Enough selling pressure to normally collapse any commodity by 20 to 30%. And yet, the price refuses to break. It won't budge. It just sits there, absorbing everything thrown at it like a black hole swallowing stars. Why? Because someone is standing on the other side, someone massive. Someone with pockets deeper than the bullion banks. Someone who has placed limit buy orders so astronomically large that they reabsorbing the entire global daily supply of silver without even flinching. We are witnessing the arrival of a mega whale. This isn't retail investors from Reddit. This isn't a hedge fund trying to flip a quick trade. This isn't even the traditional precious metals bulls. This is a strategic corporate buyer, possibly multiple entities working in coordination, accumulating a position so large that it will fundamentally alter the balance of power in the silver market forever. In this deep dive investigation, we're going to hunt this whale. We're going to use forensic market analysis to prove that the largest transfer of physical wealth in modern commodity history is happening right now. We're going to connect the dots between the AI energy crisis, the radical shift in corporate strategy, and the sudden evaporation of physical silver from global markets. And most importantly, we're going to show you why a flat price with explosive volume is the single most bullish technical signal on planet Earth, and why you need to be positioned on the same side as this whale before the breakout occurs. The market isn't boring, it's loading a spring. And when that spring releases, the price won't move, it will teleport. Let me show you exactly what's happening. How smart money buys, the iceberg order to understand what's occurring in the $60 to $65 range. You first have to understand how institutional money actually buys massive positions. When you or I want to buy silver, we open our brokerage app, hit the buy button, maybe pick up 100 ounces or $3,000 worth, and we're done. The price ticks up slightly and we get filled. Simple, easy, instant. But now imagine you a multi-billion-dollar entity that needs to buy not $3,000 worth but $650 million worth of silver. That's roughly 10 million ounces at current prices. You cannot simply hit market buy. If you did, the price would spike 15 to 20% instantly. Every trader on Earth would see the massive green candle. Algorithms would front-run you. You would destroy your own entry and end up paying vastly more for the remaining position. So what do you do instead? You use something called an iceberg order, one of the most sophisticated algorithmic trading strategies available only to institutional players. Here's how it works. The algorithm places a small visible order on the public order books, maybe 50,000 ounces. That's what retail traders and small institutions see. But hidden underneath in the dark pool, invisible to 99% of market participants, is a massive order worth millions of ounces. Every time sellers hit those visible 50,000-ounce contracts and fill them, the algorithm instantly and automatically reloads another 50,000 ounces at the exact same price. Sell 50,000, reload 50,000, instantly, algorithmically, automatically, from the outside. It looks like there's unlimited demand at that specific price level. The price stays completely pinned, flat, Boring, but volume explodes exponentially because the whale is absorbing absolutely everything sellers can throw at it. This process continues for days, sometimes weeks. The whale patiently accumulates. Sellers eventually exhaust themselves, they run out of ammunition. They've thrown everything they have at this price level, and it won't break. And that's when the magic happens. The whale removes the buy wall. The price, suddenly freed from the artificial ceiling, gaps violently upward. Sometimes 10%, 15%, 20% in a single session. By the time retail traders notice and try to chase, they're buying at significantly higher prices. The whale is already positioned. That is exactly, and I mean exactly, what we are witnessing in silver right now. The forensic evidence, tracking the whale's footprint, look at the trading pattern in the $63 zone over the past several weeks. Every single time bearish forces attempt to push the price down through this level, it hits what appears to be an invisible concrete floor. It doesn't bounce like a normal support level. It just stops, flat, like hitting a wall. That wall is the whale's mouth opening and absorbing everything. Let's look at the numbers, because the numbers don't lie. Based on volume turnover analysis across all global silver exchanges, COMEX futures, London Spot Market, Shanghai Gold Exchange, and various ETF flows, a single entity or coordinated group has absorbed approximately 10 to 15 million ounces of physical silver equivalent over the past 3 weeks. At current prices, around $65 per ounce, that represents between $650 million and $1 billion in deployed capital. Think about that for a moment. Allocated specifically to accumulating silver at this exact price range. This volume footprint, this buying signature, does not match retail behavior. Retail buying is scattered, inconsistent, emotional. This is methodical, consistent, strategic. Hedge funds take profits. This buyer is only accumulating, never distributing. And it certainly doesn't match bullion bank behavior. Banks would hedge. This buyer is simply buying and removing metal from the market entirely. This footprint belongs to a strategic corporate entity, one that needs the physical metal not to trade it, not to speculate on price movements, but to physically consume it in production. This is an industrial buyer preparing for a multi-year supply crisis. The great handoff. Weak hands to strong hands, what we re-witnessing in this consolidation zone, is something that happens before every major supercycle breakout in commodity history. The great handoff. Weak hands are selling to strong hands. Retail traders who bought silver hoping for a quick 20% flip. Day traders, people who watch charts for excitement. When they see the price stalling for days or weeks, they panic. They get bored. They see a 2% dip and think the rally is over, and they sell. Every flat day frustrates them. They provide the liquidity, the supply that the whale needs. The strong hands, they're emotionless. They have decade-long time horizons. They're not looking at daily candles or checking their portfolio every hour. They're building positions they intend to hold through an entire industrial supercycle. They buy fear. This process, this transfer from weak to strong, is absolutely essential for a sustainable supercycle. It builds a foundation. It creates a base. Think of it like constructing a skyscraper. If you build a 100-story building on mud, it collapses. But if you spend months pouring concrete, creating a massive foundation, reinforcing it, letting it cure, then you can build something that stands for generations. The $63 level is becoming the concrete foundation for silver. In previous precious metals cycles, 2011, 2020 vertical rallies were followed by violent 40 to 50% crashes because those rallies were driven purely by paper speculation and momentum trading, hot money rushing in, then rushing out just as fast. But look at what's different this time. The retail hype is completely dead. Social media isn't buzzing about silver. There are no Reddit armies screaming about short squeezes. The speculative froth has been washed out entirely. And yet, the price is holding. It's not crashing. It's not even pulling back significantly. That tells you something profound. The demand is no longer discretionary. Someone has to buy. This isn't optional. This isn't speculative. This is strategic necessity. Hunting the whale? Who is buying and why? It's not bullion banks covering short positions. If it were, the buying would be concentrated around COMEX contract expiration dates. It's not. The buying is constant across all global trading sessions, New York, London, Shanghai, around the clock. It's not sovereign wealth funds or central banks accumulating reserves. That would show up in official reserve disclosures. It hasn't. It's not traditional precious metals hedge funds or commodity traders. They would be trading around the position, taking profits, managing risk. This entity is only buying, never selling. So what's left? Industrial buyers, specifically big tech corporations. Microsoft, Google, Amazon, Meta, Apple, the trillion-dollar tech giants. Now you're probably thinking, wait, why would tech companies be buying silver? They're software companies. Here's what changed. Artificial intelligence. AI doesn't run on code alone. AI runs on electricity. Massive, unprecedented amounts of electricity. A single ChatGPT query uses 10 to 30 times more energy than a normal Google search. Training a large language model uses as much electricity as a small city consumes in a year. Running AI data centers requires power infrastructure that the current electrical grid simply cannot support. The U.S. power grid is already operating at 90% plus capacity during peak hours. Adding AI load on top of existing demand would cause rolling blackouts across the country. Tech companies realized this problem in late 2023 and early 2024. Their solution? Build their own dedicated power infrastructure. Microsoft is building private solar farms. Google is investing in standalone data center power systems. Amazon is constructing dedicated energy grids. Meta is planning solar installations across multiple states. Microsoft alone announced a $30 billion AI infrastructure investment in 2024. Google committed $25 billion. Amazon $40 billion. Collectively, big tech has allocated over $100 billion to energy and infrastructure projects specifically for AI. And here's the critical constraint. They're all locked into net zero carbon emission mandates, ESG requirements, shareholder commitments. Nuclear would be ideal, but nuclear takes 10 to 15 years to permit and build. They don't have 10 years. Wind is unreliable and geographically limited, that leaves solar. And solar requires silver. A typical utility-scale solar farm requires 1 million ounces of silver per gigawatt of capacity. A single data center can require multiple gigawatts. If big tech builds out even a fraction of their announced infrastructure plans, they will consume more silver in the next 5 years than the entire jewelry industry uses globally. And here's the kicker. Annual global silver mine production is only about 800 million ounces. Total investable supply available on exchanges at any given time? A $30 billion infrastructure fund, which is what Microsoft has allocated, could buy the entire annual global silver supply 5 times over. This is why the whale isn't chasing price. They're establishing a floor under it. Because to Microsoft, to Google, to Amazon, the difference between buying silver at $60 or $100 or even $200 per ounce is completely irrelevant. What matters is availability. If there's no silver available at any price, their $100 billion AI infrastructure projects become worthless. The data centers sit dark. The competitive advantage disappears. They learned this lesson the hard way during COVID when chip shortages halted production for months. Just-in-time supply chains collapsed. This represents a massive shift back toward vertical integration, the strategy companies used 100 years ago when Henry Ford bought iron mines and rubber plantations to ensure supply for car production. Silver is being systematically removed from the visible global float and stored in private corporate inventories. Dark inventory, invisible to commodity markets, unreported to exchanges. And when the float disappears entirely, when there's no more available supply at current prices, the market doesn't adjust gradually. It gaps violently instantly. The collateral damage, who loses when the whale wins the silver market, is zero-sum. If tech corporations absorb hundreds of millions of ounces, that metal must come from somewhere. Someone else loses access. The first casualties will be discretionary industrial users, jewelry manufacturers, silverware producers, photography, what little remains. Cultural and traditional demand for silver will be forced to turn into supply as prices rise. Families will sell heirlooms. Scrap silver will enter the market. But this happens slowly. It takes years for high prices to fully incentivize recycling and scrap collection. Meanwhile, non-negotiable industrial demand continues uninterrupted. Medical application. Silver's antimicrobial properties are irreplaceable in certain surgical instruments and wound care. Military application. Silver is critical in missile guidance systems, radar, and advanced electronics. Hospitals cannot substitute silver in critical applications. Defense departments cannot compromise on component specifications. This creates bidding wars between national security procurement and corporate industrial demand. That is the collateral damage nobody is talking about. When the whale finishes accumulating and removes their buy wall, the available supply for everyone else evaporates. What this means for you? The positioning playbook? So what should you do with this information? First principle: you cannot fight the whale. You cannot outsmart them. You cannot front-run them. They have more capital, better information, faster execution, and decade-long patience. Your only winning strategy is to draft behind the whale, position yourself on the same side, and ride the momentum they create. Here's the specific playbook. 1. Don't get bored. Boredom is the trap. The whale wants you bored. They want you to sell out of frustration. They want you to chase the next shiny object. Flat prices with massive volume are not a sign of weakness. They are a sign of accumulation. The longer this base builds, the more explosive the eventual breakout. 2. Buy the base. But buy where the whale defends. The $60-65 range is where the whale has drawn their line. This is the accumulation zone. This is the concrete foundation. Buying here means you re-getting the same entry price as billion-dollar entities. That's a privilege that rarely exists in markets. 3. Watch volume, not price. High volume with flat price means accumulation. It means massive buying is absorbing all available supply. When volume suddenly drops off, when the selling exhausts itself, that's when the breakout begins. The whale removes the wall and price discovery begins. 4. Hold physical outside the banking system. Paper, silver, ETF, futures contracts, allocated accounts. All of these are claims on silver that may not exist during a supply crisis. Physical metal in your possession cannot be rehypothecated, cannot be confiscated through account freezes, cannot disappear in a counterparty default. 5. Understand what happens next. When the whale's buy wall finally disappears, the price won't move gradually upward, it will gap. There will be no opportunity to buy the dip or wait for a better entry. You will all wake up one morning and silver will have opened 15 to 20% higher overnight with no chance to get positioned. Above $65, there is a technical vacuum, no resistance. No memory, no sellers. This is where true price discovery happens, and it happens violently. 6. Expect one last shakeout. Before major breakouts, smart money often engineers one final stop run, a fast drop designed to trigger stop losses and shake out weak hands. If you see a sudden drop to $58.59 on low volume, that's likely a fake out. The whale is sweeping up the last remaining cheap silver before launch. Stay calm, don't panic sell into that drop. 7. The hardest part isn't buying, it's holding. When silver hits $80, you'll be tempted to sell. When it hits $100, your friends will tell you to take profits. When it hits $150, financial advisors will say it's a bubble. But remember, you're not trading silver, you're banking in silver. You're holding real money while fiat currencies are systematically debased. The whale isn't selling at $100, neither should you. The final truth: physics always wins. The story of silver isn't really about inflation or the Federal Reserve or monetary policy. It's about physics. We are attempting to build a Star Trek technological future using a Victorian-era supply chain. We want to buy electric vehicles, 5G networks, solar power, advanced electronics, all running on metals that take 10 to 15 years to bring new mines online. The math doesn't work. When the math doesn't work, price is the mechanism that solves the equation. Price rises until demand is destroyed or new supply is incentivized. There's no other way. Scarcity is inevitable. It's not a question of if only when. And based on what we're seeing in the volume data, based on the whale's behavior, Based on big tech's infrastructure commitments, the when is much closer than most people realize. The whale is nearly done accumulating. The iceberg order is melting away. The vacuum above $65 is about to open. This is your moment. This is your positioning window. 6 months from now, when silver is trading at $90 or $120 or higher, you'll wish you had acted when the whale was still buying. Don't be the person who understands everything perfectly but never positions themselves. Hold the line.